Secretly, silver is revealing the largest Ponzi scam that has ever been. Gone is the spirit of the deal. End your current activity. Even as you read this, something is transpiring in the silver market about which the general public will learn nothing for weeks, if anything at all. I'm taping this a short while after the comedy afternoon session ended on January 17, 2026. As the world watches in rapt attention, the current political circus and CNBC pundits fill the airwaves with their market rotation stories. A terrifying phantom event is taking place in the silver pits, which any market expert worth their salt should find terrifying. For the past 12 years, in my capacity as a private commodities analyst, I have diligently followed these markets and accumulated physical silver. I decided to create this channel because I was fed up with having to wait half a day for major news channels to cover events that I could witness unfolding in real time. Also, I'm sick of new AI content farms giving unsuspecting retail investors empty promises and useless research. For that reason, I make use of this AI avatar. Speed. While the data is still useful, I can deliver it to you. Just a few hours ago, I witnessed something that caused me to put everything on hold and capture it on video. The number of open contracts for silver futures, which measures the market's activity, has dropped dramatically. We're discussing contracts below 150,000, a low not seen in several years. When open interest disappears at such a rate, the price ought to be plunging in a typical market. Do you remember the law of supply and demand? As demand decreases, prices fall. But it isn't really the case. As if there were an unseen floor beneath it, silver is hovering and struggling, holding it slightly under $90 per ounce. There was a bid of $89.94 and an ask of $90.24 for the spot price this afternoon. The 1.62% drop this morning was hailed by CNBC as a positive correction. Rotation back into risk-on assets is what Bloomberg's headline suggested. The silver fever of 2025 has ended, or so they would have you believe. They would have you believe that this is simply another commodity beginning to calm down following a strong run. You can't trust the screen. Even though the price is $89.94 on the ticker, the tangible metal that you can feel has already departed. This market correction is unlike anything we've seen before. The auditing of this ledger was never intended, and what we are seeing is the opening of a crack in its integrity. But the crime can only be seen in the one area where banks have no control. The United States must be considered the sovereign fault line, Mint's very own retail outlet. Just so we're clear, this video will show you the commodity status of silver has been demonetized. The United States is being indicted in this trading as an indictment. Treasury, within the paper markets, and across the entire debt-fueled system that has been operating for decades on borrowed time and borrowed metal. There is a big disparity between the screen prices of silver and their real-world counterparts. A gaping chasm. In my opinion, the U.S. debt loop is the largest Ponzi scheme in the world, and that chasm represents the first obvious break in its foundation. I realize that sounds over the top. If you're thinking, yep, another conspiracy theorist is claiming everything is a Ponzi scheme, you're not alone. In any case, I am not requesting that you accept my word for it. I'll have to do the math. The existing open interest levels constitute a mathematical impossibility for physical delivery, and I will demonstrate this to you. You will be surprised that the nightly news has not mentioned the paper-to-physical decoupling mechanism after reading my explanation. As we near the $90 support level, I will then reveal my own strategy, including what I am observing, my trigger points, and how I intend to use my capital. The goal here is not to amass vast wealth rapidly. Nothing here has to do with hopium, hype, or any of that nonsense. The goal here is to deduce the consequences of a system's sales outpacing its ownership. This pertains to the liquidity black hole that manifests itself when the music halts and the crowd discovers there are insufficient chairs. As for the initial indications of this black hole, it is positioned directly over the United States. The price tag of Mint, glaring at anybody who will look. The January 17th Great Divergence. Please review the data that I retrieved earlier today at about 1 o'clock in the afternoon. Eastern. Spot price of silver is $89.94 with an ask of $90.24. Rhodium, $45.96.87. There was blood on the larger metals complex. Silver trailed the decline at 2.55%. Palladium was in the red. Copper, too, was exhibiting signs of weakness. This seems like a classic case of taking a risk and then letting it ride. Falling commodity prices could be the result of profit-taking following last year's meteoric rise. However, this figure appears thereafter. End it. Observe this for a moment. 1-ounce silver-proof coins from 2025 are available for purchase at $173 from the United States Mint, the official coin production facility of the United States government. The current spot price of silver is $89 per ounce, while 1 ounce costs $173. So that you can see it plainly, I'll do the arithmetic right now, live. $89 divided by $173. The premium over spot is 92%. 92%. According to the government's own mint, the value of 1 ounce of silver is approximately twice what the paper market indicates. Now, I will address this fully later, but before the naysayers do, let me say this. It is a proof coin. That is correct. Due to their unique designs, restricted mintage, and collectible status, proof coins do, in fact, command numismatic premiums. This, however, is important. Proof premiums have typically been 20 to 40% above spot for quite some time. On occasion, special editions or first strikes would get a 50% discount. Conversely, 92%, nobody would call such a numismatic premium. It's a premium for the cost of replacement. Ignoring the comics ticker, that is the mint giving you the actual cost of sourcing the raw silver blanks in today's market. Allow me to illustrate the current state of affairs on the charts. Silver is in the thick of things, in my opinion. There appears to be a trend of delayed bleeding consolidation. Metal is battling for its own existence in the $90 price range. When the price drops below $89, people buy. With each step closer to $92, sales increase. A coiled spring is this. In the real world, among dealers, private mints, and the actual market, inventory is being shifted stealthily. Metal acquisition costs are at record highs, even while the paper price is falling. Prices for private mints' typical bullion rounds are $4 to $6 higher than spot. Those rounds were selling for $150 more than they do now, which may not seem like much. The most popular government bullion coin, American Silver Eagles, is currently trading at a premium of $7 to $10 over spot at major dealers. Would you happen to have some time today? So, let me tell you something. The most pressing concern now is availability. The comics are a great place to stock up on paper silver. As soon as you press a button on your brokerage account, you will be the proud owner of 10,000 ounces of silver. But see if you can get a delivery. Take that paper and turn it into something you can hold in your hand. Watch how quickly that cash goes. Then why is the mint going to charge $173? The reason being that they have theater knowledge that you do not. An arena where false hopes are staged. Give me a moment to break this down for you. For the simple reason that this is the single most crucial idea when it comes to the silver market. Pretty much any market where paper derivatives have become substantially larger than the physical asset they are based on. It's known as decoupling from paper to physical. You may see the technical definition here. When the value of an asset's digital claim becomes completely unrelated to its real purchase price, we have a systemic failure. However, you won't really get a handle on the mechanism via definitions. So, to help you understand, I'll provide an analogy. Picture this, a cinema, just 10 actual seats in a little theater. It's done. On all 10 seats, the screen is crystal clear. It has just dawned on the theater manager that selling more than 10 tickets will result in significantly higher profits. He proceeds to print and sell all 1,000 tickets. For what reason not? The system is ideal so long as there are no more than 5 or 6 patrons at any one performance. All are allotted seats. There is joy for all. Even though they just have to keep 10 chairs in good repair, the manager keeps $1,000 in ticket sales. The system appears to be fluid. In terms of functionality, it appears to be excellent. Those who possess tickets tend to think they are entitled to a seat simply because, well, they are holding the ticket in their possession. But when people start talking about how good this movie is, what happens? Assuming that 11 people turn up, what will happen? Alternatively, what about the 20th? Did you mean the 100th? An issue arises for the management out of nowhere. Even though he only has 10 seats, he has sold 1,000 tickets. Ticket holders begin to demand the goods and services for which they have paid. Their seat is their desire. That the manager made a killing off of ticket sales is irrelevant to them. Their claim is legitimate. So, the manager's role is what? Before the audience figures out there aren't enough seats, he has to bid whatever it takes to repurchase those tickets. Instead of letting them watch the movie, he has to come up with a reason for why it's delayed, why they should return tomorrow, or why they should just get a refund. The theater might go bankrupt in an instant if a sufficient number of customers reject the refund and insist on keeping their seats. The Ponzi scheme is this. This is the current state of the silver market. That theater manager is the COMEX, the LBMA, and the whole paper silver market. Even if everyone turned up at once, they still wouldn't be able to fulfill the silver claims that have been sold. Right now, why is this important? In comparison to 2020 and 2025, how is 2026 unique? Because the US silver in its physical form is required by the government's treasury. It is essential for their business operations. For their strategic reserves, it is essential. For defense contracts, it is necessary. It is necessary for the green energy infrastructure projects they have been announcing, such as the electric vehicle programs, solar panel mandates, and others. On the other hand, they require a reduction in the paper price. Why? For the simple reason that silver prices tend to rise when the dollar falls. A decline in silver prices sends a message that the world no longer has faith in the dollar. It proves beyond a reasonable doubt that inflation is higher than reported in official statistics. It ruins the argument that foreign central banks should continue purchasing US debt because of the dollar's strength. Thus, this seemingly contradictory statement emerges. Even if the government is trying to lower the paper price, It requires actual metal, and they've been using leverage to handle this discrepancy. Give me a moment to break down how leverage works. Most contracts in the futures market are settled in cash rather than actual metal. In this hypothetical situation, neither party actually trades silver. Rather, they agree to close the position at the price differential. For those that gamble, this is perfect. No hedge fund worth its salt would welcome the arrival of 10,000 Oz of silver at their office if they were betting on dollar weakness through futures trading. If your prediction of the price movement is correct, all you want is the money. However, this method is only viable if most contracts are settled in cash. 1 ounce of physical silver in the registered vaults backing these contracts is accompanied by 50 to 100 ounces of paper claims, according to current estimates, which are cautious. Keep that ratio in mind. For every seat in the theater, there are 50 to 100 tickets. A gamma squeeze potential is produced as a result of this. If a fraction of the paper contract holders opt for physical delivery rather than cash settlement, the entire system will be forced to rush to locate metal that does not exist in their vaults. Attempting to purchase an illusory item causes the price to skyrocket. Dealers who offered naked contracts, promising to supply silver when they did not actually possess any, face limitless losses. In order to meet their delivery commitments, they must enter the actual market and purchase goods regardless of price. Otherwise, they will fall into default. They make a public announcement of force majeure, revise the regulations, and apologize for not being able to fulfill their promises. This is money instead. Squeezing is no longer merely conjecture. We are not addressing the hypothetical outcome that could occur if all stars align. Based on the data, it appears that the audience is already leaving, checking out the limitless leverage. The cautious scenario should be executed. Currently, there is less than 150,000 contracts available for purchase. In fact, it's at levels not seen in several years. I'll get to the significance of that in a bit. But even at this scaled-down level, let's figure it out. There are 5,000 ounces of silver in every COMEX futures contract. The typical size of a contract is that 750,000 Oz of paper silver is the result of multiplying 150,000 contracts by 5,000 Oz. 750,000 Oz. Now we may examine the silver that is available for delivery in its physical form. The silver actually available to be delivered against contracts, known as the COMEX registered inventory, varies but has been ranging from 30 to 40 million ounces. The generous estimate would be 50 million ounces. There are 750,000 Oz of paper claims against 50,000 Oz of actual metal. Being conservative, that works out to a ratio of 15 to 1. Behold, the stress test awaits. Silver futures have an extremely busy delivery month in March 2026. Approximately 2% to 5% of contracts have traditionally stood for delivery, meaning that holders want actual metal rather than just rolling their position or paying in cash. 5% will do. 7,500 contracts is 5% of 150,000 contracts. 37.5 million ounces is the result of multiplying 7,500 contracts by 5,000 ounces. 50 million ounces is the amount recorded for inventory. Is the issue glaring? Just 5% of the present contract holders can use up 75% of the registered inventory if they want their orders fulfilled in March. That is, if no one else attempts to claim the shipment. The recorded inventory has been decreasing recently, therefore that assumption will be tested thereafter. That is, if the bullion banks have no use for the gold from their own government contracts or industrial clients. There is a 5% waiting list, 1 month of delivery, and nearly no stock on the shelves. We need to revisit that $83 difference now. A $173 mint value and $90 comic book value. We are not talking about a rally if the paper price were to match the physical reality that the mint is currently pricing in. In this case, silver does not trade between 90, 100, 120, and 150. Rather, there is a gap up, a discontinuous price movement. Since physical trading takes place at 170, the paper market will eventually have to give in to reality and open at that time. Complete success with just 1 session. What I'm about to show you adds even more intrigue to the situation. Over the last 3 years, I retrieved a chart that compared the issue of US debt to the price of silver. The difference is tremendous. Silver has begun to move inversely to that debt as the national debt continues to climb. At the moment, we are adding $1 trillion to the debt every 100 days or so. Silver is serving as a means of escape from the record-high issuance of treasuries. It's acting like the asset that people purchase when they no longer trust the government to handle its finances. The private analyst community has been abuzz with this rumor for the past month, and here it is. Several sources have stated that China has been selling US treasuries at a rapid speed. However, I am unable to confirm this, so please approach with appropriate caution. A figure of $688 billion has been floated. Consider the consequences of investing even 1% of that money in genuine silver, regardless of how inflated that figure is. Say, 50%. Just 1% of $688 billion is $6.88 billion. That works out to 76 million ounces at $90 per ounce. From only one prospective buyer, that's 1.5 times the total registered inventory of comics. There is more to the theater's seat shortage than that. The theater goes up in flames. Profitable investors on Wall Street are aware of these calculations. Big banks are familiar with this calculation. This math is known to the Fed. That's why their rebuttals are getting so out of hand, the official line of defense. Because there are two major objections against the decoupling thesis that are worth investigating, I will address the doubters directly. It is important that you think critically about this. Negative defense. To start with, a proof coin costs $173. It's rare and valuable. The numismatic worth of this item extends beyond its silver content. Spot price is not a valid comparison. I want to give this the respect it deserves because it is the strongest case against my position. True, proof coins do have a premium over their melt value. They are dyed with carefully polished pigments and struck several times. Their surfaces resemble mirrors. Authenticity certifications are included with the presentation cases. This is something that people like to gather. They are distinct from your average bullion round. This, however, is important. That premium's historical range. For more than 10 years, I have monitored the price of mint products. Premiums of 20–40% over spot have been normal for proof silver eagles. The possibility of seeing 50% exists in special years. Years with a low mintage, commemorative editions, and first striking of new designs. Premiums were as high as 70% for a few days in 2020 and 2021, when the COVID supply chain problems were at their worst. Conversely, 92%? You can't call that numismatic worth. You can't call that collection demand. There you have it, the replacement cost and mint pricing. What this means is that they are claiming they can't find silver blanks for these coins at a price that's even close to the comic's current price. Therefore, we will charge the amount that we actually spend to make them. Not even the mint functions independently. Somewhere, they'll have to pay for their silver. Refineries and suppliers have contracts with them. Also, if their suppliers inform them that the physical market isn't even close to $90, the mint will lose money on every coin they sell unless they change their retail price. An extremely unusual data figure that demands our immediate attention is a 92% premium. Second point raised by naysayers. Falling open interest indicates that people are losing interest in silver. The market is losing customers. That is negative, not positive. This seems reasonable at first glance. A futures market's open interest is the sum of all active contracts. The common belief is that a decline indicates less interest, fewer demand, and negative attitude. Open interest is something you should be familiar with. Buyers aren't the only ones. You have vendors and consumers. Someone is always on the long side and someone is always on the short side of a contract. The closing of contracts and the unwinding of holdings are indicated by a sharp decline in open interest. But for what reason? When the market is down, open interest should go down because traders selling long bets are abandoning their bullish premise. Their sales would cause the price to drop. However, our observations do not support that. Although open interest has plummeted, the price has remained stable. It is not about to crumble. This $90 level, with what appears to be a fake floor underneath it, is where it's condensing. My take on things is that this is when knowing how a Ponzi scheme falls apart becomes really important. True Ponzi schemes always end with the wise money getting out first. In front of the throng, those who are familiar with the procedure and the locations of the graves emerge. Yet, who are the astute participants in the paper-silver market? Exactly who is most suited to detect the false nature of the physical underpinning of these contracts? The banks that hold bullion? Who are the market makers? It was those very establishments that peddled those bare contracts. As a bullion bank, what would you do if you heard rumors that China is buying physical, that industrial demand is surging, and that retail stackers are emptying dealer inventory? You bet that just 200 out of 10,000 contracts would ever stand for delivery. You get out of the market. You end up responsible for paying for metal you don't have if you repurchase those contracts before the delivery month. Open interest decreases as a result. Accordingly, a decline in open interest is not always indicative of waning demand for silver. This might be an indication that the counterparties supplying the selling pressure have departed, which is what I personally think it is. Everyone hates being in a position where they have a short contract they can't meet. View it from this perspective. What does the theater manager do when he finds out that his ticket scam is getting out? He halts the sale of tickets. He might even repurchase some at a slight loss to conceal himself before the throng shows up. Nothing happens in the market. The decline in open interest begins. The underlying strain, however, is widening rather than narrowing. More specifically, the disparity between pledges made and metal accessible. Allow me to summarize the things we know with certainty. At the moment, the price is $90. It costs $173 from the United States Mint. Despite the price being same, open interest has dropped to levels not seen in some years. There has never been a wider disparity between paper claims and actual availability. Historically, there has been a lack of registered inventories. There have been whispers of sovereign accumulation, and industrial demand is on the rise. All of the pieces of this puzzle fit together perfectly. Whether or if the decoupling is taking place is not the issue. What occurs when the March delivery notifications reach the tape is an open subject, the looming liquidity conundrum. Not if, but when the situation begins to fall apart, there will be telltale signals that you must pay attention to. An immediate increase in my margin is my first priority. This is how it operates. When it comes to futures contracts, the exchanges, COMEX, and CME are the ones that decide on the margin requirements. That's the minimum required capital to maintain a position. The exchange has the authority to abruptly boost margin requirements in response to rising volatility or perceived systemic risk. The claimed reason is usually to prevent excessive volatility or maintain the integrity of the market. To get the tiny person out of his job before the big move happens is the actual motive.